You will not believe this, but the Federal Reserve themselves are now talking about revaluing gold. On August 1st of this year, straight on the Federal Reserve's own website, they published this paper titled The Official Reserve Revaluations, The International Experience. Hello and welcome back to The Deep Dive. We're the place where we take these really complex global issues and we'll try to break them down into something you can actually sink your teeth into. And today, wow, we are diving into something genuinely astounding. It's a development that maybe signals a pretty fascinating shift in how governments are even thinking about managing their money. We're talking about the Federal Reserve, the institution, tasked with keeping our money stable, openly discussing something called gold revaluation. And this isn't some speculative blog post or a fringe theory. No, this is detailed in an official paper published just weeks ago, August 1st. We're recording this on August 17th, 2025. You really can't overstate how striking this news is, not just because of who's saying it, the Fed itself, but because it brings this financial maneuver, gold revaluation, right back into the spotlight. And that's something usually associated with countries in distress, with these huge historical moments of fiscal pressure.
So today, our mission really is to unpack what this seemingly obscure financial move actually means. Why is it being discussed right now at the highest levels? And crucially, what potential implications could it have for everyone, for you? We're going to explore how this seemingly simple accounting change could potentially unlock something like $1 trillion in spending power, and what that means for the economy and, most importantly, for your daily life.
It is an extraordinary discussion. It really is. And it challenges a lot of the conventional ways we think about how money and government finance actually work. So to break down gold revaluation in the simplest terms possible, it's essentially the government changing the official legal value, the price tag, on the gold it already holds on its books. And this is super important. It's not about buying or selling gold at whatever the market price is today. Nope. It's about the value the government assigns to it for its own internal accounting, its own books.
Okay, so it's like they just decide the gold they've had sitting there is suddenly worth more on paper.
Exactly. On paper, think of it this way, and this analogy helps, I think. Imagine you own, a vintage comic book.
Right.
You might have bought it years ago for, say, $5. And that's the price you've always listed it for in your personal inventory spreadsheet, maybe. Just $5. But today, if you actually went to sell it, that same comic book could easily be worth, let's say, $500 on the open market. Big difference. Now, gold revaluation for the government is kind of like them simply changing the value in their inventory list from that old $5 to the new $500 without ever actually putting the comic book up for sale. The difference, that $495 increase in this example, well, that just becomes available on paper as a newly recognized asset on their balance sheet. Poof!
Poof is right. It's like an instant paper profit, almost. A huge reappraisal of something they already owned, but with no physical transaction, no actual sale.
Precisely. But, and this is where the crucial distinction lies, this separates what you or I, or even, a regular business can do versus what a sovereign government, one that can issue its own currency, can do. See, for you or me, if we want to actually use that extra value from our comic book, that $495 paper gain,
Right.
we have limited options. We could maybe borrow against it, use the comic as collateral, but that means debt, interest, repayment down the line.
Right. Or you sell it.
Or you sell it, exactly. You sell it to get the actual cash.
Right.
We can't just declare that gain as new money we can suddenly spend without any consequence. Our financial reality is tied to, actual flows of goods, services, earned income. However, for a government that has that unique sovereign power to create currency and, importantly, the authority to collect revenue through taxes, the rules can be, let's just say, fundamentally different. And this distinction is absolutely central to understanding the real implications of what the Fed is floating here. It sets up the core tension we're exploring today, really. It's the tension between the economic realities that apply to us, individuals and businesses, and the unique flexibility, for better or worse, that a government holds. This isn't about generating value through, say, building something or providing a service. It's about altering the perceived value of existing assets on a ledger to unlock new spending capacity. It's different.
Okay, let's definitely unpack this more. Given the radical nature of what you just described, essentially conjuring potentially $1 trillion on paper, why? Why would the Federal Reserve, an institution we usually think of as cautious, incremental, why would they be talking about this right now? The timing feels incredibly important, doesn't it? It suggests something big's going on in the background.
Oh, absolutely. The timing is everything here. And the paper itself, it doesn't really shy away from highlighting the, let's call it, dire financial situation the United States is currently facing. We are undeniably staring down the barrel of a deepening fiscal crisis. It's characterized by, frankly, unsustainable debt trajectories and these persistent deficits that just keep adding up. The national debt is already soaring way above 120% of GDP, our gross domestic product.
120%. So our debt is significantly larger than our entire annual economic output.
Yeah, and to put that into perspective, our national income is already way outpaced by the debt we've accumulated. And it's not static, it's escalating, growing faster, really, day by day.
To give you some concrete numbers,
Yeah.
the national debt currently stands at a, well, staggering $37 trillion.
$37 trillion. It's almost impossible to really grasp that number. That's like,
Yeah.
what, $110,000 for every single person in the U.S.? And bigger than the next few largest economies combined. It truly is immense. And its scale, honestly, makes the traditional solutions raise taxes, cut spending increasingly difficult, politically and practically. And this huge debt, it's compounded by this persistent spending problem that just shows no signs of slowing down. In fact, government spending is already 7% higher than it was just last year. That's a significant acceleration.
7% higher already this year.
Yeah, it's not a blip, it's a deeply entrenched trend. It speaks to ongoing policy choices, societal demands, you name it. And then if you look at the budget deficit, the gap between spending and revenue in a given year, that's also getting worse, rapidly. Year to date, right now, the U.S. has spent a staggering $1.6 trillion more than it has taken in taxes.
$1.6 trillion.
Yeah.
Just in the hole so far this year.
Exactly. That's a massive widening gap. It requires constant borrowing just to keep the lights on, essentially. So when you pull all these threads together, the skyrocketing debt, the accelerating spending, the widening deficit, and, let's be honest, the political gridlock making tax hikes or big cuts really hard, well, it makes this specific discussion about gold revaluation by the Fed incredibly interesting. It's being framed within their own paper as a potential way to maybe fix or at least temporarily patch up the severe pressures on the federal budget. The underlying message seems pretty clear. The usual tools are getting strained, maybe maxed out, and unconventional solutions are now definitely on the table.
And this is where it gets really interesting because, like you said, the Fed's paper isn't just hinting. I mean, its very first line lays out the core goal right there in black and white. It says, and I'm quoting here, "With public debt at high levels, some governments have begun to explore financing additional expenditures without raising taxes while also not increasing public debt outstanding." That almost sounds like trying to defy gravity, doesn't it?
Yeah.
How do you spend more without taxing more or borrowing more in the traditional sense?
It does sound a bit like a magician's trick, doesn't it, in that sentence? It perfectly captures the mindset, I think, of policymakers who are grappling with this fiscal mess right now. They want to keep spending money, maybe because current programs are popular, politically entrenched, or maybe they genuinely believe new spending is needed for, societal challenges or economic stimulus. But at the same time, they have to know that the current path of debt and deficits is just unsustainable. It could lead to serious economic instability down the road if they don't change course. So the traditional solutions, raising taxes or significantly increasing borrowing, they're becoming either politically impossible or economically risky, given how much debt we already have. So what do? They start searching for what they call budget-neutral ways to keep the spending taps open, methods that can seemingly conjure up funds for more spending without it looking like new taxes or new debt on the surface. It's about making new spending appear like it's not adding to the existing pile of problems.
Budget neutral. That feels like a very, very carefully chosen phrase, almost designed to sound painless. But what does it actually mean from their side? And how does it stack up against the reality for, you and me or a regular company?
Well, from a policymaker's viewpoint, budget neutral basically implies some kind of accounting mechanism, something that creates spending capacity without directly hitting those headline numbers for tax revenue or public debt. It's about leveraging existing assets, maybe undervalued ones, to create new fiscal room to maneuver. Now, for the average person, heck, even a big corporation, anybody who operates in the real economy and can't just, take money by force through taxes, this whole idea of budget neutral spending without taxes or debt is, frankly, it's nonsense.
Right. If I want to spend more, I either earn more or I borrow it.
Yeah.
That's it.
Exactly. In the real economy, the only way you genuinely spend money is you produce value. You earn it. Or you borrow it, knowing full well you've got to pay it back, usually with interest. There's a fundamental accounting reality. Value has to be created or transferred. But for a government with that unique sovereign power to literally create its own currency out of thin air, and crucially that power to tax, The rules can be, well, let's just say entirely different. They operate outside the constraints that bind the rest of us. And that unique power lets them explore these unconventional methods like gold revaluation to effectively conjure up spending power that, at least on paper, doesn't immediately show up as a direct tax hike or a new bond issuance. It's an interesting semantic dance, maybe, but it has very real economic consequences.
Okay, so the government's looking for these unique, maybe even slightly sneaky ways to finance spending. So what assets do they actually have that could play into this? Specifically, let's talk about the gold. How much does the U.S. actually hold, and how is it currently valued on the official books?
Yeah, the U.S. holds a truly enormous amount of gold. It's a significant historical stockpile. Specifically, the official reserves total 261.5 million troy ounces of gold, mostly stored at Fort Knox, West Point, places like that.
261 million ounces. That's a lot of gold. Largest holder in the world, right?
By far. Yeah. It makes the U.S. the largest official holder globally. Now, here's where the discrepancy and therefore the potential for this budget-neutral magic trick becomes really apparent. And honestly, it's kind of astounding. The current legal value of this gold, the number written on the government's books, last officially set way back in 1973, is just $42.22 per troy ounce.
Wait. $42.22 per ounce. That sounds, I mean, that's almost comically low compared to what gold trades for today. That sounds like a number from like 50 years ago?
It is from 50 years ago, precisely. And the gap is enormous. It's almost absurd. As we're talking right now, the current market price for gold is hovering well over $3,300 per ounce.
Over $3,300 compared to 42.
Yeah, that's a difference of, what, more than 7,700%? It means the U.S. government legally declares its massive gold hoard is worth significantly less, laughably less, in real economic terms, than its actual market value if they were to sell it today. So by keeping it valued at that historical $42.22 number, they are, in effect, leaving an unbelievable amount of money on the table just sitting on their balance sheet. It's this huge, untapped paper value, a dormant reservoir of potential declared wealth just waiting.
So, okay, what does this all mean then? Why wouldn't they revalue it, or at least just market to market constantly like any other major asset holder like a bank or an investment fund would? Because as you said, they're not actually planning to sell this gold, right? That's not the main idea here.
That's the absolutely crucial point, and you've nailed the core of the issue. You're spot on. The government isn't planning to suddenly liquidate Fort Knox. If you or I owned a big pile of gold and we saw its market value was $3,300 an ounce instead of the $42 we notionally paid for it, well, we'd probably either borrow against that higher value or more likely sell some on the open market to get the cash.
Makes sense.
But for the U.S. government, that's not the primary mechanism they seem to be contemplating here. And it's also really important to clear up a common misconception here. If they did decide to sell some of this gold, that act of selling itself would not inherently be inflationary. This often surprises people. They assume any big government money move automatically means inflation.
Okay, yeah, that does go against the gut feeling for some, I think.
Yeah.
How is selling, say, billions in gold not inflationary?
Well, think about it like any other normal transaction in the economy. If you sell your car to me, right, money leaves my bank account, goes into yours. But the total amount of money swirling around in the whole economy stays the same. Value just got transferred. Asset for cash. The same principle applies if the government sells gold. They'd sell it on the open market, and someone else, an investor in another country, whoever would buy it, using dollars they already have. Those dollars already exist. The government then gets those existing dollars. They could use that cash to fund spending or maybe pay down some existing debt, all without creating any new money. It's just a swap of an asset. Gold for existing currency.
So it's just moving existing money around, not creating more.
Exactly. It's just a reallocation of existing wealth and existing dollars. In fact, you could argue if the government really wanted to tap into this gold value in a way that's not just budget neutral, but also inflation neutral, all they'd have to do is just start selling some of it gradually. They'd get cash from the market, which could offset the need for taxes or new borrowing. Maybe taxpayers get a bit of a break. And it wouldn't inherently push up prices at the grocery store because no new money was printed.
Okay, so if they're not planning on selling it to raise cash, and selling it wouldn't be inflationary anyway, what in the world is the actual point of this gold revaluation exercise? Why bother with the accounting trick if the gold isn't moving? It must be serving a completely different purpose.
And this is where it becomes crystal clear. This isn't about managing assets like you or I would. It's not about liquidating reserves. This is simply It's a legal declaration, it's a financial engineering maneuver, an accounting gimmick, as you put it earlier. The core purpose is effectively to print new money or create the basis for new money to inject into the Treasury. This gives the government more cash to spend that doesn't look like it came from traditional borrowing or new taxes. It's new money, essentially conjured into existence by changing a number on a ledger. A stroke of a pen changes the declared value, and boom, new spending power appears.
That sounds almost too simple, or maybe too clever, depending on how you look at it. Can you give us a metaphor, maybe? Something to really drive home how this conjuring actually happens in principle.
Sure, let's try this. Imagine the country is like a very large old mansion,
Right.
a historic estate. Inside this mansion, deep in the basement, there's this vast ancient vault filled with historical treasures. That's the gold. Okay. For generations, the official inventory ledger for this mansion, the dusty old book in the library, has listed these treasures at a very low, outdated value, like the price from when the mansion was first built, far, far below what they'd fetch at auction today. Now, the mansion's current owners, the government, they're facing these mounting bills. The roof leaks, the grounds need upkeep, they want to build a new wing, whatever. They need more funds. And they look down at that inventory list, at that undervalued vault. So the act of gold revaluation, it's like them suddenly discovering a hidden, maybe magical trap door in the mansion's floor. A trap door that leads directly down to this vault, a door they never officially acknowledged before, or at least never valued properly. They don't sell the mansion. They don't even physically move the treasures out of the vault. No. Instead, they just declare that because this vault exists and because its contents are now officially valued at their true high market price, they suddenly have access to a huge sum of money they didn't have listed before. They just write this new higher value down on a fresh new ledger page. The key here is the money isn't earned in any traditional sense. No one bought anything, no one sold anything. It's conjured through this change in its declared value, like finding a hidden bank account you never knew you had, instantly accessible just by acknowledging it.
And that new value on the ledger, that translates into spending power.
Effectively, yes. It creates an asset on the government's or central bank's balance sheet, which can then be leveraged or directly monetized to fund spending. But, and this is the crucial takeaway for the listener, make no mistake, because this is effectively new purchasing power being created and injected into the economy without a corresponding increase in the actual supply of goods and services, it will cause inflation, or at the very least, it will exert significantly higher upward pressure on prices than there would be otherwise. This isn't value being simply transferred around like selling the gold would be. No, this is new purchasing power being created out of a change in declaration. And that, almost inevitably, leads to a debasement of the existing currency over time. More dollars chasing the same amount of stuff.
Okay. So we understand the why, the fiscal pressure, the desire for budget-neutral spending. And we get the what. It's this accounting trick, this redeclaration of value to create spending power. But the Fed paper, the official reserve revaluations, the international experience, it mentions different methods. How does this accounting trick actually play out in practice? What are the nuts and bolts, the financial plumbing, that lets this redeclaration turn into actual spendable funds for the government?
Right. The paper does provide a pretty fascinating look at how different countries have actually pulled this off recently. It outlines basically three main categories of methods. Think of them as different accounting pathways to get to the same end goal, creating that paper wealth that the government can then somehow use. So the first method is quite direct. It happens when the central bank, like the Fed in the U.S. case, just directly increases the reported value of the gold reserves right there on its own balance sheet. So their asset side goes up, specifically the gold line item shows a much higher value. But, accounting requires balance. So for their books to stay balanced, their liability side also has to increase by the exact same amount. These paper gains, this increase on the liability side, are then typically distributed straight to the central government's main bank account, often as like a special dividend or a direct transfer. So bottom line for method one, the central bank's balance sheet expands on Topper, and the government gets a direct cash injection matching that newly recognized gold value. It's almost like the Fed just writes a check to the Treasury based on the gold's revalued worth.
Okay, direct increase on the balance sheet. Cash goes to the government. Got it. What about the second method? How's that different?
The second method, it achieves pretty much the same outcome cash for the government, but it uses a slightly different internal accounting structure at the central bank. Instead of just adjusting the main asset and liability lines directly, they create a specific separate account, often called a revaluation account. The change in the value of the gold, that big paper gain, goes into this dedicated separate bucket first. And from there, that captured value is then explicitly transferred out of this special account directly over to the central government's general fund. So it's a slightly different plumbing layout, maybe offers a bit more transparency internally about where the funds originated within the central bank's books, but the end result for the government, exactly the same. They get the cash to spend.
Right. Same destination, slightly different route on the books. And the third one, you mentioned earlier, this one might have a slightly different primary aim.
That's right. The third method also uses these revaluation accounts, but its main purpose is often less about directly handing new cash over to the government for general spending and more about, well, shoring up the central bank's own financial position, tidying up its own books. In this scenario, the paper gain from revaluing the gold is used primarily to help offset the central bank's own net losses, maybe from other operations or investments, or simply to bolster its capital reserves. So, for example, if a central bank, maybe in a smaller country, had some bad investments, or if its operating costs led to an accounting loss on its official statements, well, this method lets them use the paper gain from gold revaluation to basically erase or offset those internal losses on paper.
Ah, so it makes the central bank itself look healthier financially.
Exactly. Because for central banks in, say, smaller or less stable economies, showing big losses on their books can erode public trust, it can complicate their monetary policy decisions, or even necessitate a direct government bailout. And a bailout, of course, kind of defeats the whole purpose of finding budget-neutral ways for the government to spend. So method 3 is more like the central bank using the revaluation gain for its own internal housekeeping, making its financial statements appear more robust, without necessarily printing brand new money specifically for the Treasury's immediate use. It strengthens the central bank itself, which can be important in some contexts.
Okay, that's a lot of financial jargon. Balance sheets, liabilities, revaluation accounts. I can see some listeners maybe their eyes glazing over a little bit. Can we simplify it even more, strip it right down? What is the core action happening here, regardless of which accounting path they take? What's the absolute bottom line for the everyday person listening?
You're absolutely right. It can sound complex, but the core action, it's actually incredibly simple when you boil it down. The simple explanation is basically this. The central bank currently holds a piece of paper, okay, a digital ledger entry nowadays that says, we have gold reserves worth X amount of dollars, and X is that ridiculously low, outdated number, $42.22 per ounce. Then they essentially rip up that old piece of paper and replace it with a new one, a new ledger entry that says, aha, we now have gold reserves worth Y amount of dollars, and Y is much, much bigger, closer to today's market price of, say, $3,300 per ounce. That vast difference between the old value X and the new value Y, that huge jump in declared value that translates into a corresponding massive increase in the central bank's reported assets. Okay, so they've created this huge new asset value on paper, that paper profit. What happens next? Well, it basically takes one of two main pathways to benefit the broader government structure. In methods number 1 and 2, which, again, are the most likely scenarios for the U.S. context, they effectively convert that newfound paper value into new money. Real cash, digitally created. This new money is then directly transferred over to the government's main account, the Treasury, so the government can then spend it on whatever it wants. Roads, defense, social programs, you name it. It's essentially a direct cash injection from the central bank to the Treasury, funded entirely by just changing the declared value of the gold. In method number 3, as we just discussed, they kind of keep that newly recognized value for themselves, using it internally to offset their own losses or boost their capital. Makes the central bank look stronger.
And just to be clear, for the United States specifically, why are methods 1 and 2 the likely ones, and what's the ultimate impact we should focus on?
Right. For the United States Federal Reserve, method 3 is frankly less relevant, primarily because the U.S. dollar is the global reserve currency, and the Fed, as its issuer, operates under very different financial constraints than, say, the central bank of a smaller nation. The Fed's own operational profits or losses, while publicly reported, don't typically threaten its fundamental solvency in the same way. The Fed can essentially create the dollars it needs to cover its own costs or manage its balance sheet through its various policy tools. It doesn't really need to use gold revaluation just to pre up its own books in the same way another central bank might. So in the case of the United States, if they were to do this, either method number 1 or method number 2 would almost certainly be the route taken. And the net result for the public, the bottom line, it's effectively the same regardless of which of those two they pick. The government gets a huge injection of brand new cash, potentially close to $1 trillion, without directly taxing citizens more or borrowing more from the market in the traditional way. It's a way to effectively expand the money supply, create new government purchasing power, all under the somewhat opaque guise of a mere accounting adjustment.
Okay, so this isn't just some, theoretical academic exercise the Fed is pondering in an ivory tower. It turns out There's actually a bill, like an actual piece of legislation being considered in Congress right now that proposes exactly this kind of gold revaluation. And here's the kicker, the part that makes you do a double take.
Okay.
The title of the bill is, well, pretty unexpected given we're talking about gold. It's called the Bitcoin Act. That certainly throws a modern twist into this whole ancient metal conversation, connecting dusty gold vaults to cutting-edge digital assets.
It definitely does. And it adds this incredibly intriguing, maybe even controversial layer to the whole discussion. The bill you're referring to is Senate Bill S.954. Its official, very long title, is the Boosting Innovation Technology Competitiveness Through Optimized Investment Nationwide Act of 2025.
But yeah, they cleverly made the acronym spell out Bitcoin Act.
Okay, the Bitcoin Act.
Yeah.
So what does it actually say about gold?
Yeah.
Well, if you scroll down to Section 9 of the bill, and then specifically look at subsection C, the part that deals with offsetting the cost of the strategic Bitcoin reserve, you'll find the precise mechanism for this gold revaluation laid out, clear as day. It's not subtle. Here's how it's designed to work, step by step, right there in the proposed law. First, not later than 120 days after the bill becomes law, the Federal Reserve banks would be required to tender all their old outstanding gold certificates, remember those things. The paper claims currently listing gold at that ancient $42 an ounce price. They have to hand those over to the Secretary of the Treasury.
Okay, step one. Fed gives the old low-value paper to Treasury.
Exactly. It's the Fed formally giving up its claims based on the old valuation. Then, step two. Within 90 days after getting those old certificates, the Secretary of the Treasury would be mandated to issue new gold certificates back to the Fed banks. And these new certificates, crucially, would reflect the fair market value price of the gold held by the Treasury against them, based on the price on a specific recent date. So the old, undervalued paper gets swapped for new paper that recognizes the gold's actual current market worth, hundreds of billions of dollars higher. And then comes step three, the real money shot, the mechanism for the cash injection. Upon receiving these new, much higher valued gold certificates, each Federal Reserve Bank shall, meaning must, remit the difference in cash value between the old and new gold certificates to the Secretary for deposit in the general fund within 90 days.
Well, okay, let me make sure I get this. The Fed gets new paper back from Treasury that says the gold claim is worth, say, $1 trillion more than the old paper said. And then the Fed immediately has to turn around and pay that $1 trillion difference in cash to the Treasury. That sounds like the Fed itself is footing the bill. And when the Federal Reserve foots the bill, that usually means creating new money, right? Printing it, digitally speaking.
You got it. That's exactly what it implies. And to fully grasp the history here with these gold certificates, it helps to remember. Right now, officially, the U.S. Treasury owns the physical gold bars. But that wasn't always the setup. There's a long, complicated history going back decades of the government consolidating that gold, taking it from international sources, and yes, significantly, confiscating it from American citizens and even from the banks themselves back in the 1930s. Before the 1930s, it was actually the commercial banks and the Fed itself that held a lot of the physical gold reserves. So when the U.S. government, mainly through the Gold Reserve Act of 1934, which we'll talk more about, basically nationalized gold, they had to give the banks and the Fed something in exchange for the physical metal they took. What they gave them were these gold certificates, pieces of paper that essentially said, okay, you no longer have the gold bars, but you now have this official IOU from the Treasury that represents a claim on a certain amount of gold held by us.
Ah, so the certificates are like historical IOUs from Treasury to the Fed, representing the gold Treasury took.
Exactly. And those very same IOUs, those certificates, still exist today. They sit as an asset on the Fed's balance sheet, still listing the gold claim at that original, now absurdly low, $42 an ounce valuation from the 1970s. So the Bitcoin Act essentially says, scrap those old IOUs, issue new ones reflecting today's sky-high gold price. And then the Fed, needing to balance its own digital books because the value of this asset just jumped enormously on paper, would indeed have to come up with the cash difference between the old price of gold and the new price of gold. And since the Fed is the entity that issues U.S. dollars, coming up with the cash effectively means creating it, printing it digitally, the total amount this maneuver would generate for the Treasury's general fund. It would be somewhere around $962 billion, maybe even pushing an even $1 trillion, depending on the exact market price of gold on the revaluation date. This is, plain and simple, a mechanism for a massive injection of newly created money directly into the Treasury's pocket. A huge transfer of purchasing power created via accounting.
And this is where it gets particularly fascinating, maybe even controversial for a lot of people. Because the Bitcoin Act, unlike that more general theoretical Fed paper, is incredibly specific about what this potential $1 trillion conjured up from revaluing old gold would actually be used for. It ties directly back to that provocative name, the Bitcoin Act.
That's precisely right. And it's the detail that has absolutely grabbed headlines and sparked intense debate. The Bitcoin Act, as written, unequivocally stipulates that all of that $1 trillion or so would be used to purchase Bitcoin within 5 years.
All of it to buy Bitcoin.
All of it, phased over 5 years, according to the bill's text. This is a profoundly significant proposal. It earmarks these newly conjured funds created via gold revaluation for a very specific and, for many people, highly controversial strategic purpose, acquiring a massive reserve of Bitcoin for the United States. And this immediately distinguishes it very clearly from the Federal Reserve's own paper on gold revaluation. It's crucial to remember the Fed's paper makes absolutely no comments on how any money created through revaluation should be used. It simply discusses the revaluation itself as a neutral method or tool to enable budget-neutral spending in general. The Fed paper leaves the actual allocation of any resulting funds entirely open, up to the Treasury and Congress to decide.
So the Fed paper is like, here's a potential tool, a way to generate funds, very academic almost. Whereas the Bitcoin Act says, okay, we're going to use that exact tool, and here's precisely what we're buying with the money. Very targeted. This brings to mind some recent, maybe slightly confusing, public statements from Treasury Secretary Scott Bessent. Didn't he say something that seemed to contradict the idea of the U.S. buying Bitcoin? And how does that square with this whole budget-neutral discussion we keep coming back to?
He certainly did, and yes, it caused quite a stir, especially in the crypto markets. In an initial interview, I think it was on Fox Business on a Thursday, Treasury Secretary Bessent was asked about the government buying Bitcoin, and he was pretty definitive, stating quite directly, quote, "We are not going to be buying that."
We are not going to be buying that. Pretty clear.
Seemed very clear. And that statement immediately sent shockwaves through the cryptocurrency markets. Bitcoin's price took a pretty significant tumble, like 6% in just a few hours, as the market reacted to what sounded like a firm no from the top U.S. financial official regarding government accumulation of Bitcoin.
Okay. But then he seemed to, walk it back or clarify it in a way that suddenly sounds very familiar in the context of our conversation today.
Exactly. It was a quick pivot. After seeing the market reaction, or perhaps after further internal discussion, Bessent went on to Twitter, X, whatever we call it now, to clarify his position. And his follow-up tweet included this crucial sentence, quote, "In addition, Treasury is committed to exploring budget-neutral pathways to acquire more Bitcoin to expand the reserve."
Ah, there it is again, budget-neutral pathways.
Bingo. Budget-neutral. Where have we heard that exact term before? Oh, yeah, from the very first line of the Federal Reserve's own paper on gold revaluation. The one talking explicitly about finding ways to finance spending without raising taxes or increasing public debt. And, of course, we see gold revaluation proposed as precisely such a budget-neutral pathway in the text of the Bitcoin Act itself. So the Treasury Secretary initially says no to buying Bitcoin, causing a market drop, then clarifies by saying Treasury is committed to exploring budget-neutral pathways to acquire more Bitcoin. The language lines up perfectly. This convergence of language, the specific term budget neutral appearing in the Fed paper, in the congressional bill, and then in the Treasury Secretary's clarification. Well, it seems like more than just a coincidence, doesn't it? It strongly suggests, or at least hints at, a coordinated line of thinking. Maybe even a deliberate conversation happening across different branches of government and key financial institutions. It raises that important question. Is this all part of some larger, carefully orchestrated plan? Or is it simply a fascinating convergence of ideas where different powerful players are independently arriving at the same potential, unconventional solution to fiscal challenges, perhaps signaling a strategic shift where these creative accounting methods are becoming more mainstream considerations? Whatever the case, the language used by the Treasury Secretary certainly echoes the concepts being floated by the Fed and actively proposed in Congress. It points towards a broader, ongoing dialogue about using these unconventional financial tools, like gold revaluation, possibly for equally unconventional purposes, like buying Bitcoin reserves.
Now, listening to all this, you might be thinking, man, this would be entirely unprecedented. Whether they revalue gold just to get $1 trillion for general spending, or they do it specifically to buy Bitcoin. I just can't believe something like this is even being seriously talked about, let alone proposed in actual legislation. The whole idea feels so radical, so outside the bounds of normal government finance. But guess what? As radical as it sounds today, the United States has actually done this exact kind of thing before. This isn't entirely new territory for the federal government, Or is it unique globally?
You're absolutely right. History doesn't repeat exactly, but it often rhymes, as they say. And this is a prime, really compelling example of that. If you've ever looked at a really long-term chart of gold prices, maybe going back a century, and you zoom in on the period before 1971, you'd notice something pretty striking. From 1934 all the way up until 1971, the price of gold was legally fixed by U.S. law at $35 per ounce. Okay? But if you look even before that, prior to 1933, the legal price of gold was fixed lower, at around $20.67 per ounce. So you had to ask yourself, why was the legal government-declared price of gold changing? Why did it jump from $20.67 to $35? And the answer is, drumroll, exactly what we're discussing now. It was a direct instance of gold revaluation implemented specifically in order to print more money and expand government spending power. Good job, you guessed it.
Huh, okay, so it happened before. Tell us more about that period, the 1930s. What was the situation?
Right. So let's rewind to understand the critical context before 1934. Back then, the U.S. dollar wasn't like it is today. It operated under a much stricter gold standard, essentially the physical paper dollars you carried around. They were basically glorified gold certificates. They often explicitly stated right on them that they were redeemable for gold, meaning you could, in theory, walk into a bank and exchange your paper dollars for a fixed amount of physical gold at that legally set rate of $20.67 per ounce. Now, this system was also tied to what's called fractional reserve banking, where banks only kept a small fraction of their depositors' money on hand in actual gold and lent out the rest. This created a fundamental structural constraint. There were strict legal limits on how much paper money could actually be printed and circulated. Why? Because if you printed too many dollars relative to the actual gold held in the vaults, you constantly risked triggering a bank run.
A bank run, where everyone rushes to get their gold out at once and the bank doesn't have enough.
Exactly. That's when depositors lose confidence and simultaneously demand more physical gold than the banks actually hold, leading to widespread bank failures and systemic collapse. We saw a lot of that in the early Depression. So this direct link to a finite physical asset, gold, meant there was a hard physical limit on how much paper money could safely be created. And that severely restricted the government's ability to just print more money to solve economic problems or fund massive new programs.
So the government couldn't just fire up the printing presses endlessly back then without risking immediate tangible blowback, because people could literally demand the underlying real asset, the gold. That really does put a leash on monetary expansion, doesn't it?
It absolutely did. It was a very real physical check on the power of the government and the banking system to expand the money supply and fund large-scale government initiatives. So now imagine you're the president, it's the depths of the Great Depression, the economy is collapsing, unemployment is sky high. You desperately need to find ways to spend more money, maybe on relief programs, infrastructure projects, whatever, to try and stimulate the economy, especially if you want to fund these ambitious New Deal programs without raising taxes on an already devastated population. You're going to look for ways to get around those existing limitations on money creation, right? And what better way to suddenly increase your ability to issue more dollars than to legally declare that the gold backing those dollars is suddenly worth significantly more?
Enter FDR and the Gold Reserve Act of 1934.
Precisely. This brings us directly to the Gold Reserve Act of 1934, a truly pivotal moment in U.S. monetary history. Most Americans, if they remember it at all, probably remember it as the time when President Franklin D. Roosevelt basically forced private citizens to turn in their gold coins and bullion to the government. Or, as the Federal Reserve today prefers to phrase it more delicately, the act transferred ownership of all monetary gold in the United States to the U.S. Treasury and prohibited the Treasury and financial institutions from redeeming dollars for gold, effectively ending the domestic gold standard for individuals.
Right, often remembered as FDR stealing the people's gold.
That's certainly one interpretation of the confiscation part, but the revaluation part is key to our discussion. After consolidating all this gold from citizens, compensating them at the old legal price of $20.67 per ounce, and from the banks, giving them those certificates we talked about, FDR then, through the power granted by Congress in the Act, unilaterally raised the official legal price of that very same gold to $35 per ounce. A stroke of the pen increased its official value by nearly 70%.
Wow. So effectively, he took the gold in at one price, nationalized it all under Treasury control, and then once it was safely on the government's books, he just declared it was worth a whole lot more, almost instantly creating this massive paper profit for the Treasury. Just like the mechanisms we discussed earlier, what was the direct impact of that accounting change back then?
By doing this, FDR achieved several critical goals all at once. First, and most importantly for our topic, it significantly raised the legal limit on how much paper money, how many Federal Reserve notes could be printed that were nominally backed up by that gold hoard. Because each ounce of gold was now officially valued at $35 instead of $20.67, the government could legally issue far more paper dollars against the exact same physical quantity of gold sitting in its vaults. And so that's exactly what FDR and the government did. This gold revaluation gave the U.S. government a nice, very substantial boost in cash spending power, right when they felt they needed it most during the Depression. And they got it without having to levy unpopular new taxes on a struggling population or issue mountains of new debt into an already fragile financial market. It was, in essence, a direct injection of newly created purchasing power into the government's coffers, facilitated entirely through a simple revaluation and accounting change of an existing asset. And beyond just the immediate spending boost, this act had other major implications. It effectively devalued the U.S. dollar internationally against gold, which was intended to make American exports cheaper and imports more expensive, hopefully stimulating domestic production. It also further loosened the constraints on monetary policy, giving the Federal Reserve more flexibility to manage the money supply, moving away from the rigidity of the old gold standard. So yeah, this historical episode makes it crystal clear. Gold revaluation isn't some wacky new theory. It's a tool that has been demonstrably deployed right here in the U.S. during times of acute fiscal stress, specifically to create extra financial headroom for the government.
So let's bring it back to today then. What does this history mean for us, for you listening right now? It means that gold revaluation as a mechanism to boost government spending power, perhaps in a way they can label budget neutral. Well, it has a long and established history. Not just in other countries, but specifically right here in the United States. Doing it again, it would not be unprecedented whatsoever.
That's the absolutely undeniable historical context we have to keep in mind. It's been done before, under pressure. So, the only real questions now, just like back in the 1930s, would be, if they did it again, what exactly would the money be spent on? Would it be general spending? Would it be earmarked for something specific, like the Bitcoin Act proposes? And perhaps the more critical question for you, our listener, is what would be the actual real-world impact on your daily life, your finances, your cost of living? Because let's be brutally honest here, given the sheer scale of our current problems, the fact that we are already $37 trillion in debt, and just this year to date, we've already spent $1.6 trillion more than the government has taken in taxes. Frankly, an extra $1 trillion magically appearing in the federal budget through some form of money creation, even if it's cleverly disguised as an accounting adjustment for gold, it's not going to make a significant dent in those astronomical figures.
Right. $1 trillion sounds like a lot, but compared to $37 trillion in debt and a $1.6 trillion deficit just this year, it's almost a drop in the bucket, relatively speaking.
It really is. They're not going to be able to pay off the national debt with it. They're certainly not going to suddenly start running a budget surplus because of it. And honestly, I would bet almost anything that they're not even going to slow down the current underlying pace of spending because of it. What's far, far more likely, based on all historical precedent and just basic economic principles, it would just add to the existing spend. It would become another source of funds, allowing spending to continue or even increase. And this additional spending, funded by what is effectively newly printed money, because remember, no new real wealth was created, just a number was changed on a ledger without a corresponding increase in the real goods and services available in the economy. Well, that inevitably puts further upward pressure on prices across the board. Inflation. Or at the very least, significant inflationary pressure. The direct impact on you, listening right now, is profound, even if it feels indirect. When $1 trillion is effectively conjured into existence and spent by the government, even under the fancy label of an accounting adjustment, it represents new purchasing power hitting the economy. If that new demand isn't matched by a real increase in supply, more cars being built, more food being grown, more houses available, then the inevitable result is that the existing dollars, the ones already in your wallet, your bank account, your retirement fund, they simply buy less. Your savings, unless they're invested in assets that can somehow outpace this inflation, will erode in value over time. For families on fixed incomes, for people whose wages aren't keeping up, this hidden tax of inflation fueled by money creation can be absolutely devastating. It makes everything groceries, gas, housing, utilities more expensive. It's really crucial for people to understand that while a term like budget neutral might sound reassuring coming from a government perspective, it's rarely truly neutral for the individual consumer who ultimately bears the brunt of the resulting loss of purchasing power. It's a subtle but incredibly powerful transfer of wealth from your pocket to the government's coffers, enabling more spending today at the cost of your future buying power.
So we've taken a really deep dive today, haven't we, into gold revaluation, this kind of dusty historical accounting maneuver that is now explicitly, openly back on the table for the U.S. government. Whether it's being floated as a way to fund general spending, maybe try to patch up that enormous national debt, or perhaps even more surprisingly, as a mechanism to acquire Bitcoin and build some kind of strategic digital reserve. It's a truly striking example of how governments explore these creative, sometimes almost arcane, fiscally flexible ways to manage their finances, or at least to appear to manage them without resorting to politically painful direct taxes or overt borrowing. But as we've explored pretty thoroughly today, these methods, especially when they ultimately involve effectively creating new money through sophisticated accounting adjustments, well, they often come with a very real and often significant cost for you, the individual. And that cost usually manifests as inflationary pressures, a steady, creeping erosion of your hard-earned purchasing power.
And this whole discussion, it really raises a fundamentally important, maybe even provocative question for all of us to think about going forward. In a world that seems locked into a pattern of increasing sovereign debt, facing immense fiscal pressures, and dealing with seemingly endless demands for more government spending, what other dormant or maybe currently undervalued assets might government start eyeing for potential revaluation or other forms of creative accounting in the future? What's next on the list? And maybe even more fundamentally, how does our very understanding of money, of value itself, begin to shift when a simple declaration on a piece of paper, a change in an accounting entry, can seemingly conjure $1 trillion out of thin air? It really forces us to question and reconsider the very foundations of our modern monetary system and what wealth creation truly means.
Absolutely. Well, we really hope this deep dive is giving you some fresh perspective, maybe some valuable insights into what's happening, often behind the scenes, in this complex intersection of finance, government, and potentially the future of money itself. If you found this discussion as fascinating as we did, please be sure to follow, like, and maybe share the deep dive with anyone else you know who loves to stay informed and enjoys digging into these kinds of important, sometimes hidden topics. And hey, for more in-depth content and insights, particularly on Bitcoin, but also broader financial topics, you can also follow What Bitcoin Taught Me pretty much everywhere. Twitter X, Nostr, Bluesky, Threads, Instagram, Facebook, and LinkedIn. Just search for What Bitcoin Taught Me. Thanks so much for joining us for this deep dive. We'll see you next time.